Hello, Ma'am Sari and everyone from Winter A class. We are from Group 6. We're going to present to you about accounting and finance in the international business. I hope you guys are all in the good health condition while viewing our presentation. Here are our group members. There is Nelson Fernando, myself, Roy Darmawan, also Syafa Alia, Nadia Sdirivi, Kesri Viera, Kintaka Putri, and Raditya Chava. Here are our outlines for the presentation. We're going to talk about the national differences in accounting standards, national and international standards, multinational consolidation and translation. We're also going to talk about financial management in investment decisions, financing decisions, and global money management. For the last outline, we're going to talk about the case itself, which is adopting international accounting standards. Okay, so we're gonna jump to the first LO or the first outline. It is about the national differences in accounting standards. So, what is accounting? Accounting is the language of business. It is the way firms communicate their financial positions. Accounting is more complex for international firms because of differences in accounting standards from country to country. The differences itself make it difficult for investors, creditors, or governments to evaluate firms. It is also difficult to compare financial reports from country to country because of national differences in accounting and auditing standards. So what is accounting and auditing standards itself? Accounting standards basically is the rules for preparing financial statements. They define what is useful accounting information. There are variables influencing accounting systems. There is the relationship between business and the providers of capital, the first variable. The second variable is the political and economic ties. The third variable is the level of inflation. The fourth variable is the level of economic development, and the fifth or the last variable which influence accounting system is the prevailing culture in a country. If we are already talk about the accounting standards, we'll jump to the auditing standards. Auditing standards itself is the specified rules for performing an audit. It's the technical process by which an independent person, or we call the auditor, gathers evidence for determining if financial accounts conform to required accounting standards and if they are also reliable. The diverse accounting practice were enshrined in national accounting and auditing standards. Accounting standards are difference basically between country to country. So it's difficult. Like we already talked about the previous slide. Here are the example of the national differences in accounting standards. The first example we can see, like you guys could see also from the book itself, like the first example of national differences in accounting standards, we're going to talk about the Dutch standards favored the use of the current values for replacement assets. Meanwhile, Japanese law generally prohibited revaluation and prescribes historic cost. The second example is the capitalization of financial leases was required practice in Great Britain, but not practice in France. The third example is research and development costs must be written off in the year they are incurred in the United States. But in Spain, they could be deferred as an asset and need not be amortized as long as benefits that will cover them are expected to arise in the future. The fourth or the last example that you guys could see from the textbook itself, German accountants treated depreciation as liability, whereas British companies deduct it from assets. These are the examples of national differences in accounting standards. For the implications itself, the lack comparability between accounting standards in different nations caused some confusion. Basically, the it costs like company between each country become confused, like why, like you could see the example like number four, the fourth example, like how can depreciation treated as liability, but on the other hand, on the other country, they deduct it from assets. Like it causes like confusion between companies on each country, on different country. Also, the second implication is may have found that its financial position looks significantly different in the two reports, and its investor may have difficulty in identifying the firm's true worth. Also, the last implication is so international business may find it difficult to assess the financial position of important foreign customer, suppliers, and competitors. So, if we talk about the national standards, national accounting standards, it may, you guys, or we may encounter like many difficulties because there are different standards between each country in accounting system or auditing system itself. So how could we solve this problem? Like, so how could we erase the confusion in accounting standards itself? To answer that question, we're gonna need the international standards for accounting itself, which gonna be presented by my friend on the next LO, Roy Darmawan. Thank you so much for the attention. I'm Nelson Fernando. Goodbye.
Hello, I will give presentation about international accounting standard. International accounting standard has been established because several factors. First, the rise of global capital markets during the past 2 decades has added urgency to this other form. Many companies raise money from providers of capital outside their national borders. Those providers are demanding consistency in the way financial results are reported, so they can make more informed investment decisions. There is a realization that the adoption of common accounting standard will facilitate the development of global capital markets because more investors will be willing to invest across borders, and the end result will be to lower the cost of capital and stimulate economic growth. This is international accounting standard. First, uh, IASG, or International Accounting Standards Committee, as the first standardization for accounting in all of countries, or all of countries. And IASG has been established in 1973. Next, there is IASB, or the International Accounting Standard Board, has emerged as a major proponent of standardization. And now, IRS as the next level above IASB to provide standard with high quality, enforceable, and global for accounting activities. For IASB was formed in March 2001 to replace the International Accounting Standard Committee, or IASG. Why are the international accounting standards important? The first, the growth of transnational financing and transnational investment has created a need for transnational financing. Second, many companies obtain capital from foreign providers who are demanding greater consistency. And the last, standardization of accounting practice across national borders is probably in the best interest of the world economy. These international accounting standards Let's answer the problem of lack comparability in a national standard by every country. And this is solution to make an effective for reporting and investment. And this is useful for all users as investor or stakeholders in the company. So international accounting standard is important to use if we make a financial reporting or make a decision about investment.
Okay. Next, I'm Shafa Alia. I will present the number three, which is the multinational consolidation and translation. So, what is a consolidated financial statement? Consolidated financial statement combines the separate financial statement or more companies to yield a single set of financial statement, as if the individual companies were really one used by multinational firms. And the IASB requires firms to prepare consolidated financial statement as do most industrialized nations. What is the MNCs on the currency translation? So, so the foreign subsidiaries usually keep the accounting records and prepare financial statement in the local currency. So to prepare the consolidated financial statement, all the local financial statement must be converted to the home countries. And there are two methods to do this. And the first is the current rate method and the temporal rate method. So the current rate method is the exchange rate at the balance sheet date. So we use the exchange rate at the balance sheet date to translate the financial statement of the foreign subsidiary into the home country of the multinational firm. So it can present a misleading picture of the financial situation, and sometimes the method is incompatible with the historic cost principle. And the second one is the temporal method is the asset values in the foreign currency is translated using the exchange rate that exists when the assets are purchased. Avoids the problem to associate with the current rate method, but it's still quite problematic because different exchange rates are used to do this. And there are the accounting influence on control system, and the control process have three steps. The first is the subunit goals are joint, determined by the head office and the subunit management. And the second one is the head office monitors subunit performance throughout the year. And the number three is the head office intervenes if the subsidiary fails to achieve its goals and takes corrective actions if necessary. So exchange rate influence on the control. The budget and performance data are usually expressed in the corporate currency, normally use the home currency, and they facilitate comparison between subsidiaries, but can create distortion in financial statement. Donald Lazard and Peter Lawrence firms can deal with the problems of exchange rate and control in three ways. The first one is the initial rate, the spot exchange rate when the budget is adopted. And number two is the projected rate, the spot exchange rate forecast for the end of the budget picture. And number three is the ending rate, the spot exchange rate when the budget and performance are being compared. So this is the Lazard and Lawrence model. We can see there are three. The first is the initial, where the budget at initial and the actual at initial, and there's the projected, where the budget at projected and actual at projected, and there are ending, which is the budget at ending and actual at ending. And there are the transfer pricing influence on control. So what is transfer pricing? Transfer pricing is the price at which goods and services are transferred within the firms is the transfer price. So transfer price can be manipulated to can be manipulated for what? And there are three. And the first one is to minimize tax liability. The number two is to minimize import duties. And the number three is to avoid government restriction on capital flows. So subsidiaries operate in different environments which influence profitability. So the evaluation of subsidiaries should be kept separate from the evaluation of its manager. A manager evaluation should consider two things. The first one is the country's environment for business, and it should take place after making allowances for those items over which managers have no control. Okay, thank you. That's it from me. So it will be, my friend will continue it. Thank you.
Next, my name is Nadia Sdirivi Prihadiani, and I'm going to talk about financial management. Financial management involves three sets of decisions. The first one is investment decisions, and then financing decisions, and lastly, money management decisions. These decisions are more complex in international business thanks to different currencies, tax regimes, regulation on capital flows, economic and political risk, etc. Good financial management can create a competitive advantage because it reduces the cost of creating value and adds value by improving customer service. Next, I'm going to talk about the first out of three sets decision in financial management, and that is investment decisions. So, what is investment decisions? Investment decisions is where firms decide which activities to finance. In deciding which activities to finance, financial manager in an international business must quantify the benefits, costs, and risk associated with an investment in a given location, or in this case, foreign country, by considering many economic, political, cultural, and strategic variables. To do this, financial managers use capital budgeting, which is a technique to quantify the benefits, costs, and risks of an investment. It involves in estimation of cash flows associated with project over time and discounting them using an appropriate discount rate to determine net present value. The most commonly used discount rate is the firm's cost of capital. If the NPV of the discounted cash flows is greater than zero, firm should go ahead with the project. This enables top managers to compare in a reasonably objective fashion different investment alternatives within and across countries so they can make informed choices about where the firm should invest its scarce financial resources. Capital budgeting is in practice a very complex and imperfect process, especially in international business, because first, a distinction must be made between cash flow to the project and cash flows to the parent company. Second, because political and economic risks, including foreign exchange risks, can significantly change the value of a foreign investment. And lastly, the connection between cash flow to the parent and the source of financing must be recognized. Project versus parent cash flow. Now, cash flow to the project does not equal to cash flow to the parent company. Cash flow to the parent company may be lower because the project may not be able to remit all its cash flows to the parent because cash flows may be blocked from repatriation by the host country government, taxed at an unfavorable rate, or the host country local reinvestment requirements. Parent companies are interested in the cash flow they will receive as opposed to those the project generates because those are the basis for dividends, other investment, repayment of worldwide corporate debt, and so on. Adjusting for political and economic risk. Political risk is the likelihood that political forces will cause drastic changes in the country's business environment that hurt the profit and other goals of a business. Political risk tends to be greater in countries with social unrest or disorder, or where the underlying nature of the society increase the likelihood of social unrest. When political risk is high, there is a high probability that a change will occur in the country's political environment that will endanger foreign firms there. Political change can result in the expropriation of a firm's assets, complete economic collapse that renders a firm's asset worthless, or in less extreme cases may result in increased tax rates, limit a subsidiary's ability to remit earnings to its parent company, imposition of price controls, and government interference in existing contracts. The likelihood of any of these events impairs the attractiveness of a foreign investment opportunity. Economic risk is the likelihood that economic mismanagement will cause drastic changes in a country's business environment that hurts the profit and other goals of a business. The biggest economic risk is inflation, or a drop in the value of a country's currency on the foreign exchange market. For firms with assets in the foreign country, this can be a serious problem because the value of the cash flow of the parent company received from the subsidiary will fall as the currency depreciates. Now, the likelihood of this occurring decreases the attractiveness of foreign investment in that country. Risk and capital budgeting. Firms analyzing foreign investment opportunities can adjust for risk in at least two ways. The first way is treat all risk as a single problem by raising the discount rate in countries where political and economic risk is high. So, for example, a firm might apply a 6% discount rate to potential investments in countries with economic and political stability, and it might use a 12% discount rate for potential investments in countries with greater perceived political and economic risk. The higher the discount rate, the higher the projected net cash flows must be for an investment to have a positive net present value. And the second way is lowering future cash flow estimates to account for adverse political or economic changes that could occur in the future. Raising the discount rate is a common practice, but many critics argue that this isn't the best approach since it penalizes early cash flows too much and doesn't penalize distant cash flows enough. So, critics argue that if the political or economic risk was expected to be high in the near term, firms wouldn't make the investment anyway. Therefore, a better way to adjust for political and economic risks is the second approach. Thank you. Next up will be presented by my friend.
Hello, my name is Kasilvira and I will continue the presentation about financial management and financing decisions. Next. When considering its option for financings, an international business must consider how the foreign investment will be financed. If extra financing is required, the firm must decide whether to tap the global capital market for funds or borrow from sources in the host country. If the firm is going to seek external financing for a project, it will want to borrow funds from the lowest cost source of capital available. The cost of capital is typically lower in the global capital market than in many domestic capital markets. But in some cases, the government of some country require the foreign multinational to finance projects in their country by local debt financing or local sales of equity. In response to host government policies, the firm needs to consider local debt financing for investment in country while the local currency is expected to depreciate on the foreign exchange market. Next. Money management is a decision attempt to manage the firm global cash resource most efficiently. This involves minimizing cash balance, reducing transaction costs, and minimizing the corporate tax burden. Next. First, we are going to discuss about minimizing cash balance. Every business needs to hold some cash balance for servicing accounts that must be paid and for ensuring against unanticipated negative variation from its project cash flow. The international business must decide whether to whether each foreign subsidiary should hold its own cash balances or whether cash balance should be held at a centralized depository. Firms prefer to hold cash balance at a centralized depository for three reasons. The first one is by pooling cash reserve centrally, the firm can deposit larger amounts. Cash balance are typically deposited in liquid accounts because interest rates on such deposit normally increase with the size of the deposit. By pooling cash centrally, the firm should be able to earn a higher interest rate than it would if each subsidiary managed its own cash balance. Next is if centralized depository is located in a major financial center such as London, New York, or Tokyo, it should have an access to information about good short-term investment opportunities that the typical foreign subsidiary would lack. Also, the financial expert at the centralized depositories should be able to develop investment skills and know-how that managers in the typical foreign subsidiary would lack. And the last reasons is the firm can reduce the total size of the cash pool it must hold in highly liquid account, which enable the firm to invest a larger amount of cash reserving in longer term, less liquid financial instrument that earn a higher interest rate. Next. Next is reducing transaction costs. Transaction costs are the cost of exchange. Every time a firm changes cash from one currency into another currency, it must bear a transaction cost, or the cost commission fee it pays for foreign exchange dealers for performing the transaction. Another transaction cost is transfer fee that most banks charge for moving cash from one location to another. The volume transac the volume of transaction cost is high in a firm that has globally dispersed web of interdependent value creation activities. Multilateral netting allows a multinational firm to reduce the transaction costs that arise when many transactions occur between its subsidiaries by reducing the number of transactions. Multilateral netting is an extension of bilateral netting. Under bilateral netting, if a firm's subsidiary owes a Mexican subsidiary $6 million and the Mexican subsidiary simultaneously owes the French subsidiary $4 million, a bilateral settlement will be made with a single payment of $2 million from the French subsidiary to the Mexican subsidiary, and the remaining debt being cancelled. Under multilateral netting, this simple concept is extended to the transaction between multiple subsidiaries within an international business. Next. This is the last one from this chapter. I'm sorry, I mean the last one from financial management, global money management, reducing transaction, managing tax burden. Every country has its own tax policy. For example, in Germany and Japan, the tax rate is lower on income distribution to stockholders as dividends, whereas in France, the tax on profit distributed to stockholders is higher. Many nations follow the worldwide principle that they have the right to tax income earned outside their boundaries by entities based in their country. For example, the US government can tax the earnings of the German subsidiary of an enterprise incorporated in the US. Double taxation occurs when the income of a foreign subsidiary is taxed both by the host country government and by the parent company's home government. Taxes can be minimized through tax credit, tax treaties, deferral principle, and tax haven. A tax credit allows an entity to reduce the taxes paid to the home government by the amount of taxes paid to the foreign government. A tax treaty between two countries is an agreement specifying what items of income will be taxed by the authority of the country whereas the income is earned. For example, a tax treaty between the United States and Germany may specify that a US firm need not pay tax in Germany of any earnings from its German subsidiary that are remitted to the United States in the form of dividend. The deferral principle specifies that parent companies are not taxed on foreign source income until they actually receive a dividend. For the international business with activities in many countries, the various tax policies and the tax treaties have important implications for how the firm should structure its internal payment system among the foreign subsidiary and the parent company. Some firms use tax havens such as Bahamas and Bermuda to minimize their tax liability. A tax haven is a country with an exceptionally low or even no income tax. International business avoid or divert income taxes by establishing a wholly owned non-operating subsidiary in the tax haven. Next. Pursuing the objective of utilizing the firm's cash resources most efficiently and minimize the firm's global tax liability require the firm to be able to transfer funds from one location to another around the globe. International business use a number of techniques to transfer liquid funds across border. The first one is dividend remittances. Payment of dividend is the most common method by which firms transfer funds from foreign subsidiary to the parent company. The dividend policy typically varies with each subsidiaries depending on a few factors. The first one is regulations. The higher the rate of tax levied on dividends by the host country government, the less attractive these options becomes relative to other options for transferring liquid funds. The next factor is foreign exchange risk. Firms sometimes require foreign subsidiary based in high-risk country to speed up the transfer of funds to the parent through accelerated dividend payments. This moves corporate funds out of a country whose currency is expected to depreciate significantly. The third factor is the age of the subsidiary. Older subsidiaries tend to remit a higher proportion of their earnings in dividend to the parent, presumably because a subsidiary has fewer capital investment needs as it matures. And the last factor is the action of local equity participant. Local equity participant is a factor because local co-owners' demand for dividend must be recognized. The second technique is royalty payments and fees. Loyalty represents the remuneration paid to the owners of technology, patents, or trade names for the use of that technology or the right to manufacture and/or sell products under those patent or trade names. It is common for a parent company to charge its own foreign subsidiary royalties for the technology, patents, or trade name it has transferred to them. A fee is a compensation for professional services or expertise supplied to a foreign subsidiary by the parent company or another subsidiary. Fees are usually levied as fixed charge for the particular services provided. Royalty and fees have certain tax advantage over dividends. Royalties and fees are often tax deductible locally because they are viewed as an expense. So arranging for payment in royalties and fee will reduce the foreign subsidiary's tax liability. If the foreign subsidiary compensates the parent company by dividend payment, local income taxes must be paid before the dividend distribution, and withholding taxes must be paid on the dividend itself. Although the parent can often take a tax credit for the local withholding and income taxes it has paid, part of the benefit can be lost if the subsidiary combined tax rate is higher than the parent's. Next. Next is transfer prices. Transfer prices are the prices at which goods and services are transferred between entities within the firm. They are for gains can be derived by adjusting transfer prices. The first one is the firm can reduce its tax liabilities by using transfer prices to shift earnings from a high tax country to a low tax one. The firm can use transfer prices to move funds out of a country where a significant currency devaluation is expected, thereby reducing its exposure to foreign exchange risk. Next is the firm can use transfer prices to move funds from a subsidiary to the parent company or a tax haven when financial transfer in the form of dividends are restricted or blocked by host country government policy. And the last one is the firm can use transfer prices to reduce the important duties it must pay when an ad valorem tariff is in force. In this case, low transfer prices on goods or services being imported into the countries are required. Since this lowers the value of the goods or services, it lowers the tariff. There are also significant problems associated with pursuing a transfer pricing policy. The first one is when transfer prices are used to reduce a firm's tax liabilities or import duties, most governments feel they are being cheated or manipulated by their legitimate income. Similarly, when transfer prices are manipulated to circumvent government restriction on capital flows, government perceive this as a breaking the spirit of the law. Many governments now limit international business ability to manipulate transfer prices in the manner described. For example, US has strict regulation governing transfer pricing practice. Another problem associated with transfer pricing is related to management incentive and performance evaluation. Transfer pricing is inconsistent with the policy of treating each subsidiary in the firm as a profit center. When transfer pricing are manipulated by the firm and deviate significantly from the arm's length price, the subsidiary's performance may depend as much on transfer prices as it does on other pertinent factors such as management effort. And the last technique to transfer liquid funds across borders is fronting loans. A fronting loan is a loan between a parent and its subsidiary channeled through a financial intermediary, usually a large international bank. In a direct intra-firm loan, the parent company lends cash directly to the foreign subsidiary, and the subsidiary repays it later. In a fronting loan, the parent company deposits funds in international business and the bank then lends the same amount of the foreign subsidiary. For example, US firm might deposit $100,000 in a London bank. The London bank might then lend $100,000 to an Indian subsidiary of the firm. Firm use fronting loans for two reasons. First, fronting loans can circumvent host country restriction on the remittance of funds from a foreign subsidiary to the parent companies. Second, a fronting loan can also provide tax advantage. For example, tax haven subsidiary deposit $1 million to London Bank with 8% of interest. The bank lend the $1 million to a foreign operation subsidiary with 9% of interest. The foreign operations subsidiary pays $1 million plus $90,000 interest to the London Bank. Deducting this interest payment from its taxable income result in a net after-tax cost of $45,000 to the foreign operating subsidiary. The London Bank received the $90,000. It retains $10,000 for its services and pays $80,000 interest on the deposit to the tax haven subsidiary. This is the end of our presentation about accounting and finance in international business, and we will continue to case discussion.
My name is Kintaka and I want to explain about the benefits of adopting international accounting standard for business enterprise. So based on our research, there are three benefits that the business enterprise can get to for adopting international accounting standards. So the first one is if the company are adopting the international accounting standard, they can reduce the cost of preparing consolidated financial statement since the accounting statement has been standardized, so they don't need to make another adoption anymore. And then the second one is they can improve the reliability and credibility of financial report since the accounting system has been standardized. And then the last one is they can improve the international investment since the investor and other stakeholder find it more convenient to compare their business performance, with another companies in international. So this will make it easier and cheaper for them to raise business capital from investors across the world.
Okay, Assalamualaikum warahmatullahi wabarakatuh. Good morning, good afternoon, and good evening, everyone. My name is Raditya Chava, and now we will discuss about the case of adopting international accounting standards. I'm not alone here. we will discuss with my partner Kintaka Putri. So let me read aloud about the case in the highlights. Following a European Union mandate from January 1st, 2005 onward, some 7,000 companies whose stocks is publicly traded on European Stock Exchange were required to issue all future financial accounts in a format agreed upon by the International Accounting Standard Board or IASB. Some 65 countries outside of the EU have committed to requiring that public companies issue accounts that conform to IASB rules. And American accounting authorities have been trying to mesh their rules with those of the IASB. Historically, different accounting practices made it very difficult for investors to compare the financial statements of firms based in different nations. After the 1997 Asian crisis, a UN analysis concluded that before the crisis, two-thirds of the 73 largest East Asian banks hadn't disclosed problem loans and debt from related parties. About 85% of the banks didn't disclose their gains or losses from foreign currency translation or their net foreign currency exposures, and two-thirds failed to disclose the amount they had invested in derivatives. Had this accounting information been made available to the public, it is possible that problems in East Asian banking system would have come to light soon, and the crisis that unfolded in 1997 might not have been as serious as it ultimately was. Another example of the implication of differences in accounting standards, first Morgan Stanley Research Project found that country differences in the way corporate pensions expenses are accounted for distort the earnings statement of companies in the automobile industry. The US auto companies charge certain pension costs against earnings and fund them annually. It's generally understated their earnings and had stronger bias. Japanese auto companies took no charge against earnings for pension costs, and their pension obligation were largely unrecorded, and it had lower earning and weaker BS. The examples of the implication on implementing ISB is first, Shell, the large oil company, announced that adopting ISB would reduce the value of assets on its balance sheet by 4.9 billion US dollar from change in the way Shell must account for employee benefits. The second, L'Oreal, French cosmetics companies that they have the net worth of their brand fell from 8.1 billion to 6.3 billion euros due to a change in the way certain classes of stock were classified. But some companies will benefit from the shift. For example, Vodafone, the UK-based mobile phone company, reported profits for the last 6 months of 2004 would have been some 13 billion higher because they would not have had to amortize goodwill associated with previous acquisitions against earnings. And we will have three questions to discuss about this case. The first The first question is, what are the benefits of adopting international accounting standard for A, investors, and B, business enterprise? So the first benefit for the investors is there is three benefits for investors. First, it's facilitating comparisons of companies across borders. So investors can compare uh, from one from one companies to other companies and others companies. So investor can have conclusion which companies that perform the best of their economic activity, and which are the companies that more profitable for them to invest. And the second is the reduction in the cost of preparing consolidated financial statements for multinational firms. So, from the international accounting standard, the investor can deduct the cost of preparing consolidated financial statements. So it will ease their works in preparing or consolidating the financial statement for multinational firms. So the more is their job, so the is the company and the benefits for them. And the third or the last is the improved reliability and the credibility of financial reports. So the financial reports will attract, or maybe the investor will be interested because uh, the companies has a reliable and credible uh, financial reports with international accounting standards. So the second question is, what are the potential risks associated with a move in the nation toward adoption of international accounting standards? So there is three potential risks that associated with a move in a nation toward adoption of international accounting standards. The first is increase in cost associated with adopting change. So it change in accounting standards to adopt a more widely accepted standard need adaptation training. So it will more costly for companies with adaptation adaptation training. And the second is loss of efficiency. The implementation of the new standards are time consuming, expensive, and overall inefficient. This is the risk that someone will change from one point to another point. Not only in this case, but in another case, uh, the change are time consuming, expensive, and overall and inefficient. And the third, lack of funding. The international accounting standards must be sustained by corporate funding, as it is not government funded nor self-sustaining. So um, the funding will burden the corporate or the companies in order to adopt of international accounting standards.
And then the last question is, in which nation is the move of adoption of IASB standard likely to cause revisions in the reported financial performance of business enterprise in the US or China, and why? So in international accounting standard, there are two kind of system. The first one is the principle of IFRS that are issued by the International Accounting Standard Board, or IASB, and then and in this principle in IFRS, they are most likely using across the world, for especially in Europe. While JAP are issued by Financial Accounting Standard Board, or FEASB, which is adopted by most likely in US company. Between IFRS and JAP, there are several kind of difference in how they recording their system. For example, like inventory recording system in JAP, they are still use the last in first out method to estimate the inventory, while in JAP they are not allowed this method anymore. And then the last one is in China, they're using their own standard too. They called Chinese Accounting Standard, or CAS, that are issued by the Chinese the Ministry of Finance in China. In 2006, the government introduced a revised accounting law, which is adopt a significant number of the accounting standard laid out by IASB. They said the similarity between them is almost 19 and 95%. Now we can see that in this evidence, maybe the Chinese standard more or less have revision in the reported financial performance rather than the US. But from another data evidence that are that are performed by Etcher and Hawley in 2000 and Lin and Chen in 2005, they are using data from 1990 through 2001. They are comparing the value relevant of TAS with the value relevant of the International Accounting Standard. The study find out that the counting number reported of JS tend to be more value relevant than reported using ISB. So the GIS can better suit to capturing the value of Chinese firm rather than international standard. And another evidence is more recently in 2012, Chinese firm that adopt IFRS in 2007 and examine that the effect of the fair value proposition under IFRS. They find that IFRS result in increased earning and increased earning manipulation among Chinese firms with a large portfolio of trading securities and debt restructuring. So overall, the prior research generally suggests that IFRS adopted in China may not necessarily improve report the financial reporting quality. So the conclusion is to adopting the International Accounting Standard Board by or IFRS is tend to be more difficult for Chinese company rather than for U.S. companies, since in GAAP there are have been attempts to link the FASB standard to the IASB standard. So that's all from our group. Thanks for watching. Hopefully it will be good for you. Thank you.